Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about two strategies that I have not covered before, which are calendar and diagonal spreads. Now, these are what we call time spreads, and many times they can be quite intimidating at first because they don't fall under the traditional mold of vertical spreads, but in reality, they are just a slight deviation from the topics that we learned last week, which are credit and debit spreads. They are simply similar to credit and debit spreads in concept, but with different expiration dates. And that is what tends to throw a lot of investors off when they're using these types of strategies. So I will say that the precursor to understanding today's session is an understanding of the fundamental building blocks of options trading, which are the four core strategies: buying the call or a put, and then selling a call or a put. If you don't have a strong understanding of these four fundamental strategies, you may find today's topic a little intimidating and difficult to understand, which is why we have links back to that video to help you better understand that. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off today using understanding calendar and diagonal spreads, which, as I said, is really taking what you've learned in terms of the fundamental building blocks and show you how creative you can get with options to really create the payoffs and the strategies around the different types of outlooks that you may have on an underlying stock. The value of options is really the fact that you can get really, really creative. And for us to show you calendar and diagonal spreads is really just giving you an understanding as to how creative you can get. Tomorrow morning, we're going to be doing a rapid fire session for members. This is where we have our members submit symbols as to the stocks and ETFs that you want to review. I will research those stocks before our session and provide a rapid fire session where we try to go through, we average about 40 symbols in that 1 hour, going through those symbols and showing you what I currently feel where those stocks currently sit. And then next week, we kick off earnings season. So we've already had some early reports in the season. Delta reported this morning. We have a Southwest trade on. Delta reported some strong earnings this morning. So I'm going to give you a little bit more in-depth understanding as to the research that I do when I post earnings plays. And for those of you that follow me on CNBC, we do a lot of earnings plays around earnings season. So I want to give you a little a more in-depth look into all the things that I look at before I post a earnings play. And then the last Thursday of this week, we're going to be talking about selling straddles and strangles, really taking everything that we've learned here with the fundamentals of options and showing you just how creative you can get with these types of strategies. So let's go ahead and get started here. For today, we're going to start off talking a little bit about the difference between stocks versus option strategies, really understanding what challenges that you have when you're trading options, specifically looking at buying call options. What are the challenges that you have there? How you can negate some of those challenges by trading a calendar spread, and some of the downsides, if you will, of a calendar spread to show you how you can negate some of that by using a diagonal spread, depending on what your views are in the markets. And then talking a little bit about the optimal spreads and how to manage these spreads once you're in them. And we'll try to do some live analysis with Q&A here at the very end. I'm actually just going to interject some of the live analysis as we go along. So the primary, I would say, thing that we're trying to accomplish here for investors who are starting out with options is showing you how you can use options creatively, because at the end of the day, there are only four fundamental building blocks. Every single complex strategy that we're going to talk about here, whether we're talking about simple complex strategies like debit and credit spreads, or more complicated ones like calendars, diagonals, straddles, strangles, iron condors, butterflies. As you get more complicated, they're all just using the fundamental building blocks to create them. And this is why I stress so much on that beginner's webinar of buying versus selling options, that regardless of how experienced of an options trader you are, that you take the time to learn those fundamentals, because once you understand those fundamentals, you can take any type of strategy and understand it. But if you don't understand the fundamentals, you're really going to struggle with some of these more complicated strategies. So we want to show you how you can use options creatively to reduce the risk and time decay of a long call or a long put. So long calls or long puts are bullish and bearish strategies. That's really what we're trying to solve for, is how can you effectively buy a long call or a long put, but take on less risk and negate some of the time decay. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what I want to do is I want to show you how creative you can get with your options to create the risk profiles that you're seeking. So first, I want to talk a little bit about stock versus options trading. And the reason for that is because when you trade stocks, when you buy a stock because you think a stock's going to go higher, that is a strategy that is what we call symmetrical risk to reward. Meaning if the stock goes up by $1, you make $1 on the stock. If it goes down by $1, you lose $1. You know exactly how much you risk or gain if the stock goes higher or lower. And there's no time a concept when you're investing in a stock, meaning you can own a stock for as long as you want, and for as long as you hold on to that stock, you gain exposure in the underlying stock. So the question becomes, for many investors, how do you achieve similar type risk profiles with an option while still maintaining the convexity of an option? What do I mean by convexity? Meaning if the stock goes higher, you want to participate in upside, but if the stock goes lower, you want to limit your risk. That's why we trade options, because when we buy a call option, our risk is limited to the downside, but if we're right, we can keep making more and more money here to the upside. So what we're trying to do here is we're trying to overcome some of the challenges that we have with buying a call versus buying a put, and using options to help us overcome some of those challenges. Now, last week, we talked about debit and credit spreads. We talked about how a debit spread is helping you reduce the cost of buying a call or a put, and selling a credit spread is by reducing the risk of selling a naked call or a naked put. So today, what we're here to talk about are two strategies that are more similar to debit spreads. They'll help you reduce the risk of a long call or a put, and also at the same time reduce some time decay. So in order to understand a little bit more about calendar and diagonal spreads, or which is what we call time spreads, that's when we're buying and selling calls and puts of different expiration dates. Now, in order to understand the motivation behind that, we have to look at what we call the theta decay curve. Now, what I have here on my screen is not to scale, but it's meant to show you the concept. And the concept is really showing you how much time decay an option has as it approaches expiration. So how many of you are familiar with this chart? Please type 1 into the chat window if you're familiar with this chart, which is the fact that if let's say you own a 1-year option, when you hold it for the 3 months, between 12 months and 9 months, the call option will actually experience a relatively small amount of decay. Now, from 9 months to 6 months, it'll experience a little bit more decay. 6 months to 3 months, a little bit more. And then what you start to see is that you get this really sharp acceleration in the last 3 months, and most of it actually comes within the last month. You actually erode the largest amount of the extrinsic value of an option as you get closer and closer to expiration. So what we've learned in our buying versus selling options is that, as a general rule of thumb, when you're buying, you want to buy longer dated options, because the longer dated option that you buy, the slower amount of time decay you experience during your holding period. Even if you only intend to hold on to an option for 1 month, the amount of premium that you decay on is very low. Now, if you buy a short dated option, you're going to experience a very high amount of decay. Now, the problem is that the further out you go in time, the more expensive it is. But this is really where we want to maximize the fact that we can trade different expirations. Now, when we trade a debit spread or a credit spread, we're always trading the same expiration. But when we're trading a time spread, what we can do is even maximize this curve. What we can do is we can say, okay, we're going to buy an option that's somewhere out here, maybe 3 to 4 months out, 4 to 5 months out, and then we sell an option that's out here. Because time decay works in our favor if we're long. Longer dated options work in our favor because they have less time decay. And then what we can do is we can short a shorter dated option and actually experience that acceleration of time decay. So, and the concept of time spreads comes from this concept that the longer dated options have lower time decay and shorter dated options have faster time decay. So if we can effectively arbitrage the two, we can offset some of the time decay that we want to purchase. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Okay. Perfect. Okay, so I see a lot of 2s now. Now, if you're still new to options or if you're still new to these time spreads, don't worry, we're going to walk you through it. So let's take a real example here. Apple is currently trading at $130 a share. And maybe I think that, sometime in the longer dated, and this is more of a longer term view, maybe I feel that in the longer term, I think Apple's going to rise maybe to 150 or 160. Whatever my views are, I think Apple is going to rise, right? So one of the strategies that I can trade instead of outright buying the stock is that I can buy a call option. So let's say I buy a 6-month call option. Let's say, this should say $130 call option, the at the money call, not a $100 call. So I'll correct this when we send out the slides. So this is a $130 call option, and at the money call option, let's say it costs $13 to buy. My max risk is $13. My max reward is unlimited. And that's really why we buy call options, is because we want the limited risk nature of a call option, but we want the unlimited reward. But the challenge with a call option is that in this particular case, even though I'm bullish on stock XYZ, my break-even price here is $143, which is 130 plus 113. So again, my apologies for the typo here. It's 143 is my break-even price. So the stock has to move $13 higher over the next 6 months before my strategy is profitable. That's a big move. That's not a small move here to the upside. So the reality here for many investors is the fact that when you buy a call option, the stock needs to make a pretty big move before you're profitable. Sometimes that move is larger than what you think the stock is capable of making. I only think the stock's going to go to 150, but the stock has to move to 143 just to break even. So even if the stock does, in my particular case, move all the way up to 150, my potential reward here is fairly limited. I'm only potentially making $7 if the stock goes all the way up to 150, while I'm risking 13. That doesn't sound like a great risk reward. It doesn't make me want to get out of bed every single morning to make these types of bets where I'm risking 13 to make 7. Does everyone understand the challenges that you have when you buy a call option? Please type 3 into the chat window if that makes sense to you. And for those of you that have been following my education for a while, you've probably have heard me say this many, many times, but that's the biggest I would say learning lesson that you have with options is the fact that you have to overcome the cost of that call option. And that is never an easy task. For those of you that joined me on Tuesday afternoon with Tom Sosnoff, this is really why we spend so much time selling options. This is why we spend so much time buying spreads to reduce that time decay factor. So today, what we're going to do is take a look at how can you get creative with options to offset some of this time decay. Now, when this is really what we discussed last week with debit spreads. Debit spreads is one creative way to reduce the cost or reduce the risk of your trade in exchange for by reducing your risk a little bit. Today, what we're going to do is we're going to do a trade similar to what we talked about here on debit spreads. But what we're going to do is we're going to change the expiration dates instead of the strike prices. So in the what we're going to do here again is I have Apple stock trading at 130. Now, in this particular case, long term, I still think the stock is going to go to 150. But what I'm going to show you is a calendar spread. And I'm going to show you a calendar spread first, and then I'll show you a diagonal spread second. A calendar spread is what we call a short-term neutral play with a long-term bearish, a long-term bullish outlook on an underlying stock. So here I'm going to do the same thing. I'm going to buy the 6-month $130 call option. This is the at the money call option, and I'm paying $13 for it. So same example as I did before. If I bought this call option outright, my break-even price is 143. The stock has to be above 143 in 6 months in order for this strategy to be profitable. But as you can see, buying a call option for $13 requires a big move to the upside in order for me to be profitable here. So how can I reduce the cost of my trade so that the stock doesn't have to move as far before I'm profitable? And how can I also further reduce my risk? So a calendar spread, what we're doing here is we're buying the 6-month option, which has lower time decay. And then what we're going to do is we're going to sell a 1-month option, the same strike price, $130. And in this particular case, I'm going to collect $7 in credit, almost a little bit more than half of the cost that it takes for me to buy a 6-month option. I'm actually going to collect in a 1-month option. And what this does is reduce, number one, my overall debit from $13 down to just $6 in terms of my max risk. So now, before I was outlaying $13 per share or $1,300 a contract. Now my net outlay is only $6 a share or $600 per contract. So I've reduced my risk right now by a little bit more than 50%. Now let's take a look at this trade. Like, why would anyone want to trade a calendar spread? So this really comes down to a couple of things. As you can see here, the calendar spread, here's a graphic of the calendar spread. And right now, this is the 130 price. 130 is right here, right dead here in the center. So the way that a calendar spread works, and the chart that you're looking at right now, what it represents is the payoff graph at the expiration of the first option. Whenever you look at a payoff graph of a time spread, it's always going to look like a curved graph. And the curved graph is always going to express the value of the option, the estimated value of the option at the expiration of the first option. So what it's basically doing is assuming that 1 month later, the 130 call option that you've sold either expires worthless or has some losses if the stock has moved substantially higher, offset by the cost or the value of the 6-month call. That's what the graph represents. Now, when you trade a calendar spread like this, there are effectively two possible outcomes. Number one, because you've sold the 1 month call at 130, this is similar to selling a cover call at 130. Imagine the 6-month 130 call that you own is similar to owning the stock. And then what you've done is you've sold the 1 month at the money call option and collected $7. So just like a cover call, at the end of the month, you have effectively two possible outcomes. You could have, the stock can either be above your strike price in 1 month's time, or it could be above your strike price in 1 month time, or it can be below your strike price at 1 month time. Now, as you can see here, the calendar spread has maximum value at 130 at the first expiration. Now, I'm going to walk you through as to why that happens. And this is really because if the stock closes at 130, exactly 130, 1 month from today, what happens is that the 1 month call that you've sold for $7 now becomes worthless. What that means is you've collected $7 in premium and you got to keep it all if the stock's at 130. So the call option expires worthless, you keep the $7. And then what happens is that the 6-month call that you purchased here for $13, that has now aged 1 month. So instead of being a 6-month option, it's now a 5-month option at the same strike price. Now, the thing is that because we know that the 6-month option decays at a much lower rate, a month later, this may no longer be $13. Maybe this is somewhere around $11. So what you've done is you've lost $2 on the 6-month call, but you've gained 7 on the 1-month call. So maybe this is a better way of writing it. So 1 month later, if nothing moves, your call option, your 6-month call option is going to be worth less. But remember, a 6-month option decays slower than a 1-month option, versus the 1-month option decays by increasing your value by $7. So basically, in this 1 month, what you've effectively done is you've made $500 on this particular trade. And that's exactly why this shows roughly about a $500 gain here to the upside, because we're approximating that over the 1 month time, if nothing changes in terms of the stock price, you're going to lose $2 on the long dated options, but then you're going to gain $7 on the short dated options. And that results in a $500 gain just because the stock hasn't moved. And what you still own is this 5-month call option at 130 for now. That's now trading at because it's still trading at, in this particular case, $11, but you've gained $5 in terms of profit. So your total outlay now is still only $6 on this particular trade. So you effectively own a 5-month $130 call option for a net price of $6. If you had just bought the call option for $13, the stock would have to move to 143 in order to break even. But because the call option, the 1-month call option, expired worthless, you're now effectively owning this $5-month at the money call option for just $6. You've significantly reduced the cost of your long dated call option. So that is in essence how a calendar spread works. Now, I know this is a little complicated, so I'm going to go through this again with the diagonal spread. Hopefully that makes a little bit more sense. But if this makes sense to you, please type 4 into the chat window. And if this confuses the hell out of you, please type 5 into the chat window, because I do think it's important that we address whether this makes sense to you or if this is confusing to you. Okay, so I see a lot of 4s, but I've also seen a significant number of 5s where this is a little confusing to you. Again, if this is confusing to you, I do recommend that you go back and watch the webinar series on buying versus selling options, because that really helps clarify, how these two legs work in conjunction with each other. What you're effectively trying to do is you're trying to reduce the cost of this trade by selling a call against it. But we're selling a shorter dated call because we're going to collect more premium. We're going to collect it faster. So even if the stock doesn't move, we're going to be able to now own a longer dated option at a much cheaper price if the stock doesn't move significantly higher. Okay, so I think another way to take a look at this, and it probably will make a little bit more sense for some users, is actually the diagonal spread, because I think more of you will understand this a little bit more, right? So Apple stock's still trading at 130. I think the stock's going to go higher. Now, the reason that we're looking at diagonals is because a lot of people will say, well, why would I trade a neutral strategy? Why do I think Apple's going to stay at 130 when I think it's going to go to 150, right? And that's a very, very reasonable question. Why would I trade a neutral strategy on a stock that I think is going to go higher? And that's why we're going to look at diagonal spreads. So I'm going to do the same thing. I'm going to buy a 6-month $130 call option for $13 because I think Apple stock is going to go higher. But again, $13 is a lot to pay, and I don't want to pay that much, or certainly maybe I don't feel comfortable paying that much. So now I think it's going to go higher, but let's say I sell a 1-month $150 call option, and now instead of collecting $7, I collect $4. So I'm collecting a smaller premium here, but I'm also reducing my risk just like I did before. I'm just not reducing it as much. Before, I reduced it by $7, which brings my net debit to $6. Now, I've reduced my net debit from $13 only down to $9, but I get a little bit more upside here. So same thing, two possible outcomes, just like when you sell a cover call, the stock can either be above the strike price that you sell, or it can be below the strike price that you sell. Now, what's different about a diagonal spread is because you're selling different expiration dates, but you're also selling different strike prices. What this strategy gives you is a little bit more upside. And now, as you can see, the peak here for the value of the option is at is actually in between 130 and 150. And what you're going to do is you're going to actually maximize your value when it's at 150, because if over the next month the stock rises from 130 to 150, what happens is that the 150 will still expire worthless. Imagine selling a cover call at 150 and the stock closes at 150. That's pretty much your best case scenario for your cover call. Well, it works the same way for diagonal spreads. So if the stock 1 month later closes at exactly 150, then what happens is you keep the $4 credit. Not only do you keep the $4 credit here from the 150 calls that you've sold, but because the stock moved 20 bucks higher and you own the long call, you're going to gain some money here on the call option as well. Maybe you gain another, I don't know, what's a good number here when it goes from 130 to 150. Maybe for that you gain, let's say, $8 on that. So now your net gain on the whole trade is $12. So you only laid out $9, but you're actually going to be able to gain $12 if the stock basically makes the move here to the upside to the amount that you're looking for. So the best way to think about calendars and diagonals is not much different than a cover call. The question is really just what strike price do you want to sell your cover call at? On a diagonal, on a calendar, you're effectively selling a cover call at a price that's much closer to the current price. It's going to gain a lot more premium, but it limits your upside. And actually, if the stock makes a big move to the upside, the losses that you have on the short-term option actually exceed the gains that you have on the long call. So that's why if you trade a calendar spread and the stock moves a high amount, you actually lose money on the trade. So that's why a lot of traders will trade diagonals, because it's like selling a cover call with a higher strike price. You're going to get less credit for the higher cover call, but you're going to get more stock upside. And if the stock takes off significantly, you're typically with the diagonal spread, if the stock takes off and goes to infinity, you have no losses. You will have small gains, but you will not have any losses. And really the rule of thumb there, a lot of investors kind of get confused about this when it comes to diagonal spreads. But basically, if the debit that you pay is less than the width means the difference between the two strike prices. So here I'm buying the 130, selling the 150s, and I'm buying it for $9. If the debit that I pay is less than the width, then I will incur no losses on a big rally. So in this particular case, even if the stock rallies to 1,000, I'm not going to have a loss because what I've paid is less than the width of the diagonal spread. Now there are some times, so for example here, if you think about a calendar spread, the width here is 0. Now because I'm paying more than 0, I'm paying $6 in this particular case. That's why if the stock makes a big rally, I'm actually going to lose money on this particular trade. So those are some key differences between a calendar and diagonal spread. And I know that it can be quite confusing at first, but if you really break it down to its core pieces, you're effectively trying to take a long call position on Apple because you're long-term bullish, and you're trying to reduce the cost basis of that long call by selling a cover call against it. The question is just what strike price do you sell your cover call at? Do you sell it more aggressively like a calendar spread and collect as much premium as possible because you're more neutral, perhaps even mildly bearish on the stock in the short term, but long term you're bullish? That's when a calendar spread makes more sense. And then if you're short term mildly bullish, that's when you want to give yourself a little bit more room, sell a higher cover call. You're going to collect less premium for it, but you're going to give yourself a little bit more room to the upside. Does that make sense to everyone? Please type 6 into the chat window if that makes sense to you. And part of the reason that I think calendar and diagonal spreads are confusing really comes to the fact that there are so many different outcomes, I'm listing this as two possible outcomes, but in reality there are more outcomes than that. And for some investors it just is difficult to wrap your head around all those possible outcomes and how to deal with it. So let's just try to go through some examples here. And I think, again, the best way to think about calendar and diagonal spreads is don't think of them as calendar and diagonal spreads. I think it's better to think of them as cover call trades first, and then replacing the stock leg with a long call. And that's how you effectively end up with either a calendar or diagonal. So I'm going to use Apple here. It's trading just around 128.91 right now, just shy of 130. And let's say I want to buy a 6-month call option because I don't know. I think their AR technology that they're building right now is going to maybe launch in the next 3 to 5 months. So I'm bullish, long-term bullish. But because there's no news coming out in the next month or so, how do I capture this long-term bullish view without paying too much in time premium? So going out to July, as you can see, I'm paying $1,255 or $12.55 for the 130 calls. My break-even price is 142. That's a decent amount for the stock to rally in the next 6 months. So what I'm saying to myself is, okay, in the next month, I don't expect anything is going to happen. I think that the stock's going to stay put. So how can I offset some of the cost of that call? So imagine if you owned Apple stock and you didn't think that it was going to move very much over the next month, but long-term you're bullish. What would you do? You could potentially sell a cover call. That's exactly what we're doing here. We're selling the February 130 calls against it, collecting $6.20. So I'm effectively offsetting half the cost of my 6-month call by betting that the stock is not going to go above 130 by February. Does that make sense, everyone? Please type 7 into the chat window if that makes sense to you. Now, for many investors, they might say, well, I do think the stock's going to go above 130. I think that maybe over the next month, the stock could rise to 140. Maybe you don't think the stock can go to 150 or 160, but maybe over the next month, you say, I think it'll go to 140. So this is really where you have to decide how far do you want to sell your cover calls. Maybe you want to buy that 140 cover call or sell the 140 cover call, sorry. Here, as you can see, I'm still going to buy the $12.50 June 130 call, but because I think there's a little bit more upside over the next month, so I'm going to change this from selling the 130s to the 140s. So just like a cover call, when you sell a higher strike cover call, you're going to collect less premium. Before, for the 130s, I collected $6.20. For the 140s, I'm only collecting $2.93. So I'm offsetting less of my long call price, but I get a little bit more upside. So if the stock rallies $10 over the next month, I'm always going to have a little bit more upside than if I sold that that calendar spread. And the calendar spread only works if you think the stock's not going to move very much. And also, if you look at this chart here, for some investors that look at this, you're going to notice that it looks like a straddle, right? Or a short straddle. But what's interesting about the diagonal spreads is that eventually they taper off. A straddle has limited risk. I'm sorry, a straddle has unlimited risk, right? Because a short straddle looks like this. Whoops. A short straddle looks like this, where it goes down to infinity. But a calendar and diagonal spread, what happens is that they actually start to taper off. So you have limited losses here to both sides. And that's really why, calendar and diagonal spreads many times are traded by investors who believe that volatility is going to come lower, because you actually get a risk profile very similar to short a straddle or a strangle with a limited risk strategy versus outright shorting the straddle and strangle, which has unlimited risk to the downside. So, these are all just tidbits, if you will, and it's hard to really, in my opinion, go through all the different scenarios, because at the end of the day, you can't go through all the scenarios. This is simply an introduction, if you will, to just how creative you can get with options. Last week we talked about using same expiration, but playing around with different strike prices to create debit versus credit spreads. Now, what we're talking about is really being creative, not only with the strike prices, but also with the expiration dates. So let's talk a little bit about calendar spreads. Um, Typically, the long leg will be anywhere from 90 to 180 days out. You can go further out in time, but the further out in time you go, the more expensive those calls get. The short option will usually always be in the 30 to 60-day window because short dated calls you always want to sell, in that 30, 45, 60-day window. Anything outside of that, you're going too far out in time and you're not going to collect enough time premium. And if you go shorter than 30 days, you're actually taking on a fair amount of gamma risk. And you don't want to take on that gamma risk because short dated options, that gamma risk is going to work against you. And the long dated options have very little gamma. So you have nothing to offset that gamma risk. So that's why when you're selling a short dated option, always in that 30 to 60-day window. And what you're basically going to do is you're going to buy an at the money call or a put and then sell the same strike price call or put against it. And again, this is a neutral strategy. And the reason that you would choose a call or a put, it really is dependent on long-term, whether you're bullish or long-term you're bearish. Long-term you're bullish, you trade the call calendar spread. Long-term, if you're bearish, you would trade the put calendar spread. Now, when it comes to volatility, the reason that investors will short a straddle is because there's short volatility. And this is really where it's important to understand the optimal settings for this type of strategy. It's best when the short dated volatility is high because that's what you're selling. You're selling premium. So the higher the short dated volatility, the better. And the longer dated volatility should be lower. So when the short dated volatility is higher than the longer dated volatility, that's when you're able to even further optimize this particular strategy. It's many times suitable for earnings when you have a neutral outlook. So if you ever had a stock that you think is just not going to move very much on earnings, that's exactly what a calendar spread will allow you to do. Now, I would say that many investors that feel that the stock's not going to move, they can also sell a straddle and a strangle. But to trade a straddle and a strangle or a short straddle and strangle, number one, requires a lot more capital. So it's not very capital efficient. And number two, if the stock does end up making a big move in one direction or another, you have unlimited risk when you're selling a straddle and strangle. So a calendar spread many times is a better way. Number one, it's capital efficient because the debit that you pay for a calendar spread, that's your max loss by the first expiration date. And you don't take on unlimited risk if the stock doesn't make a big move. So that's why calendar spreads are actually very popular amongst earnings plays because they're effectively trying to take advantage of the volatility crush on the short dated option and then hoping that the longer dated option does not have as much volatility crush as a short dated option. And that differential is really what you're maximizing when you're trading a calendar spread on an earnings play. On a diagonal spread, this is really where you have more of a bullish or bearish view. And so like I showed you before, if you're long-term bullish and you think in the short run the stock is going to make a small move to the upside, that's when you want to trade a diagonal spread. Same thing, you're going to buy that 90 to 80, 180 day long dated option, sell the 30 to 60 day short dated option against it, and you always will buy the at the money call or a put as a long leg and sell a relatively out of the money 20 to 30 delta call or put against it. Similar type deltas to what you would choose if you were selling a short dated cover call. For this type of strategy, also the same thing. When short dated volatility is higher than the longer dated volatility, that is your most optimal environment to trade these types of strategies. And they're generally suitable for earnings with a mildly bullish or bearish outlook. And the reason that we are saying this is a suitable strategy for earnings, again, is because you have that volatility crush around earnings, which is the biggest problem that you have if you were just to outright buy a call or a put into earnings. So to offset that volatility crush, you sell a very short dated option that has that extreme volatility crush. And hopefully the goal of this is to offset all, if not a good chunk of the volatility crush that you would experience on the long call or put. So that is generally speaking how you should view a calendar and diagonal spread. So a few tips on managing these types of trades, because again, there are a lot of different outcomes that you can potentially come across. So what we want to do is talk a little bit about what are best practices. Generally speaking, with these types of strategies, what you're most concerned about is when you're either approaching or after the expiration of the first leg, what you're going to do, right? So a lot of investors have questions around what do you do as you approach expiration of the short dated option. Now, all of these adjustments that I'm going to show you are only applicable if you still maintain your long-term neutral, mildly bullish or mildly bearish view. If, let's say, you get into a calendar spread because you're neutral on the stock, and after the first call, the first leg is about to expire or it's approaching expiration, and you no longer have a neutral view, and maybe now you have a bullish view or a bearish or a bearish view, that's when you want to get out of the trade entirely and reassess what your new position should be. So everything that I'm showing you so far is assuming that the view that you have on the stock when you originally entered this trade is still the view that you have at the expiration or when you're approaching the expiration of that first leg. So the rule of thumb, similar to a cover call, is that you always want to roll your short call or a put within 1 to 2 weeks of its expiration. So if we sell in this particular case, if we sell a February 130 call or sell the February 140 call, as you start to approach that February 19th date within the last week or two, you want to roll this call the same way that you want to roll a covered call. So as the stock approaches the 140s level, if the stock is moving higher, you want to make sure that you cut your loss. You want to make sure that you buy back the call option and sell maybe a March call option. Now, at that point, you have to reassess where is the stock trading, what strike would you sell that cover call at, and that's a similar call that you would sell for March. But the goal is to allow you to continue to lower the cost of the long call or put. So let's say in this particular case, I sell the February 140 call and I collect, let's say, roughly $3. So what that basically is doing is I'm reducing my $12.50 outlay, reducing it by about $3. So now my total outlay gets down to about $9.57. So now, instead of owning a 6-month call option for $12.50, I now own a 5-month call option for $957. I've reduced my cost basis on that overall trade. Now, if I'm able to do it again for March, let's say I collect another $3. Now what I've done is I've now reduced my cost basis even further. Now my June option, instead of costing me $957, only cost me about $6.50. And if I do it again for April, maybe bring my call option cost down to $3. Go out to May, I maybe bring it down to 0. And the goal is to just manage these types of trades so that you can maintain your long call option, but continuously erode the cost of that call option as close to 0 as possible. You're not always going to be able to get down to 0, but you can get pretty close by selling these short dated options against it that give you a decent amount of upside over the next month, but also at the same time reduce a fair amount of the erosion or fair amount of the time decay that you have. Now, eventually what happens is you're going to approach the expiration of your long dated option, and you're going to have to ask yourself, do I want to maintain my long-term bullish view? If that's the case, then you might want to roll your June options maybe out to January 2022. But as you approach the expiration date of your long option, you also have a few other choices as to what you can do. And again, this is really the complexity that you start to add when you add time spreads to your strategy. So if you're brand new to options trading, I don't expect you to go out there and start trading time spreads tomorrow. This is meant to inspire you and show you just the opportunities that are out there and the different ways that you can creatively use options to create the payoffs that you're looking for and really negate some of the The challenges with trading options, which for the most part is the time decay that you have to pay when you're buying a call or a put when you have a long-term bullish view, and how can you offset that and still maintain a relatively limited loss in your account, or limited max loss for each strategy that you trade. So calendars and diagonals are, in my opinion, one of the most creative ways to utilize options to offset your bullish or bearish view of buying a call or a put. But they are actually, in my opinion, one of the more complicated strategies. Number one, to wrap your head around, and number two, to figure out exactly, based on all the different scenarios, how do you want to handle expiration? Do you buy it back? Do you sell another cover call, or do you simply just let your long call sit there? There's a lot of different things, and there's a lot of different options, because you can sell, the at the money call option and turn into a calendar. And here's the thing. When we talk about calendars being at the money, it doesn't have to be exactly at the money. You can buy a slightly out of the money calendar. In this particular case, Apple's trading at 128. Maybe I buy a 135 calendar because I think that over the next month, the stock will be mildly higher. So I want that out of the money call option at a relatively cheap price. How do I do that, right? So if I just outright bought the long-term call option, let's say I buy the June 135 call option. June 135. That's going to cost me $10.45 versus if I bought the June 135 call calendar, I'm sorry, the February June 135 call calendar, it only cost me $6.10. So instead of risking $1,045, I'm only risking $610. So you get really creative here. You don't have to just trade, strike prices that are exactly at the money. You can trade all different types of strike prices. And many times investors will trade a calendar that looks something like this because they want to give themselves a little bit of room to the upside. It's rare that people say that the stock's just going to stay where it is and not move very far. Most people have some directional bias, maybe slightly higher, slightly lower. And that's really where you can make adjustments to your strike prices to achieve that. And there are so many different variations of this strategy. I can't possibly show you all of them, but this hopefully gives you an idea as far as how creative you can get. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you some understanding around these time spreads. And inspires you to take a look at some of these strategies. Even if you don't trade it exactly that the way we do, you might have your own, I would say, variations on this. And over the past couple of days, I've got some emails from members who reached out to me recently, telling me a little bit about their experience trading with OptionsPlay, what they liked, and I really enjoyed some of your responses to me, telling me how you analyze some of my trade ideas, how some of them you decided to go along with them and some of them you decided that you were going to pass on them. I felt really proud to hear that from investors, to hear that they didn't just take an idea that we had and said, I'm going to trade that because you told me to trade that. I'm really proud that some of you are taking the time and taking this education and applying it, saying that I learned something from you and I applied what I've learned to the ideas that you sent, and I made a decision for myself as to whether that strategy is best suited for my investment profile. And I really hope that that's what some of you take away from these weekly educations that we do, because that's really why I sit here and I do this, is because I want you to be self-sufficient in your abilities to learn and understand the strategies that you trade, that you should never just follow myself or anyone on TV or any other investment professional that, even if they're a spectacular trader, never ever follow someone blindly. Always understand what you're trading so that you can make decisions for yourself. So with that, I want to thank our members for allowing me to continue to do this every single week. And I really am thankful for so many of you that have reached out to me over the past few months, and specifically the last few weeks, to tell me a little bit about your story and a little bit about your experience with OptionsPlay. So again, if any of you have some to share, please feel free to write to me. Sometimes I don't always get back to you immediately, but I really take time to answer all of your emails that reach out to me. So feel free, send me your feedback. Let me know, how you value these, how you're finding the education. because that's really what drives me to continue to do this week after week and find new topics and continue to improve your education going forward. So thank you so much. So with that, what I'll do is I'll open this up for Q&A. For those of you that are currently on a free trial, if you want to sign up for a membership and attend our Friday morning market outlook session tomorrow morning, which is a rapid fire session, this is really a session that you can attend. And for those of you that are members, you're automatically registered. You don't have to do anything else. You can sign up for a membership at trade.optionsplay.com. And if you're brand new to OptionsPlay, you can sign up for a free trial for 30 days at optionsplay.com. So at this point, what I'll do is I'll open this up for Q&A. There's both a chat window and a Q&A window at the bottom of your screen. If you don't mind, please type your questions into the Q&A window, and I will answer your questions out of that screen. Thomas is saying, don't you have to own shares to sell a cover call? You absolutely do. You have to own shares in order to sell a cover call, but you can also cover those calls with a long call. You don't have to own the shares. You can actually have a long call to offset the requirement of that of owning the stock. So that's why, you know, it's a fair comparison to make for calendars and diagonals as similar to a cover call. Casimir is asking a great question. What option level do you need to trade calendars and diagonal spreads? Casimir, it depends on your brokerage firm, but most firms, if you have the ability to trade spreads, meaning I believe that's level 3, you should be able to trade calendars and diagonals. Will you circulate the PowerPoint for the deltas? Yes, Philip. All of our YouTube recordings, which is how we send out the recordings, have the PowerPoint slides included in the description. So you can go to any of our videos on YouTube, look in the description. The link to the slides are available in the description. Jake is asking, I sell short options on diagonals every 1 to 2 weeks. Is that wrong? Jake, it's not wrong, but what you have is what we call gamma risk. And I saw another question about gamma risk. So I'm going to try to get into the concept of gamma risk without confusing a lot of investors here. So gamma refers to the sensitivity of the option as you get closer and closer to expiration. So effectively, you know, when the stock is far away from expiration, for every dollar that the stock moves, the option's not going to move too much. But as you get closer and closer to expiration, even a small move in the underlying stock will result in a big move in the underlying option. And that's why some investors that, you know, are buying out of the money call options like to buy short dated options, because if they do get a quick move in the underlying stock, the short dated options will always move faster than the longer dated options. So that works against you if you're in a calendar or diagonal spread. So let's say I trade this diagonal spread, and in the last 2 days, let's say 2 days before expiration, the stock is at 130. But in the 2 days between that and expiration, the stock makes a small move here to the upside. I'm going to experience a very significant drop in P&L in those last 2 days than if it made the same move 3 weeks from expiration. So that's what gamma risk is. Gamma is just the sensitivity of an option to the underlying stock price, and it gets more and more sensitive as you get closer and closer to expiration. And what happens is that the short dated option is going to lose more value than any gains that you have on the long dated option. And that's why you have negative gains if the stock makes a big move as you get closer and closer to expiration. So that's the risk that you take when you sell only very short dated options. I generally, and this is part of the reason why, if for those of you that watched the webinar with me and Tom, we sell options that are roughly 45 days from expiration so that you don't take on this type of gamma risk. Tony is asking, Tony, another great training presentation. I'm definitely going to extend my trial to full membership. Thank you so much, Tony, for your support. He's asking, most trainings that I have been in have recommended higher in the money long calls for diagonals, somewhere above 70 delta. Recently, I'm seeing more 50 deltas or in the money for one strike out of the money. Can you elaborate? So here's Tony. The reason that first of all, I would never ever advocate selling an in the money option, because if you sell an in the money option, you're effectively reducing the time decay that you have. In the money options have lower time decay, so that completely negates the concept of a diagonal spread. You always want to sell out of the money or at the money. At the money actually have the highest amount of time decay, and the further you go out in time, the less time decay that you actually have. So that's why the calendar spreads are very popular amongst time spreads traders, because as you can see, this 130 call collects $7. I'm reducing basically the risk by 50%. That's a whole lot of risk that I'm reducing in just 1 month for my 6-month call option. If I can do this 2 months in a row, I've effectively owned this call option for free. Because if I collect another $7 next month, then I effectively own what is going to be a 4-month at the money or $130 call option for free. That is why you generally want to sell an at the money option, never an in the money option. So I hope that answered your question, Tony. Jake is saying, on stocks that I think may rocket up, I sell very short-term calls against longer calls like BNTX. Jake, I can't help but think that for stocks that you think are going to rocket up, selling short-term calls is possibly the worst thing that you can do, because the short-dated calls are going to lose more money on that rocket higher than what you're actually going to gain on the long-dated call option. So if you think the stock's going to rocket higher, number one, you shouldn't sell any calls at all. Just own the long call. Just keep the long call. Why would you want to sell calls against a stock that you think are going to rocket higher? That effectively is the wrong thing to do. Ed is saying, can you elaborate on gamma risk? I think I just discussed that. Why 50 deltas for the long side diagonal spread? I like 60 or 70 deltas because they're more conservative. Is that okay? So Ed, I also, I've changed my views a little bit on this recently. I used to also think that it's better to buy the 60 to 70 delta call options. But, from my perspective, the 60 and 70 deltas will increase risk. They will reduce gamma, so you actually have less convexity. So the whole point of buying an at-the-money call option is to have this hockey stick convexity, so that you have limited losses to the downside, but still participate here to the upside. The in-the-money options have much more of a stock position than you do of the hockey stick convexity. So from my perspective, the 50 deltas just give you more leverage with less risk. 60 to 70 deltas give you less leverage with more risk. So yes, you're right. It's more conservative. And if you're more comfortable with the more conservative approach, then that's your own prerogative. And Ed, that's exactly what I want to hear from investors. And that's the feedback that I want to hear. And it makes me really happy to hear that, investors are not just saying, hey, I'm taking what you're doing and I'm just following it because you told me to do it. You're thinking for yourselves and you're saying to yourselves, I'm a little bit more conservative, so I prefer that 60 to 70 delta. And that is the adjustment you're going to make, Ed. What that shows me is that you're understanding what I'm teaching and you're learning to take that and make adjustments on your own. So Ed, thank you so much for sharing. And I think your approach is absolutely fine. Julia is saying, how does trading a spread eliminate the risk of assignment? Julia, it does not eliminate the risk of assignment, but the 6-month call option that you own, the right that you have on the 6-month call, the right that you have to own the shares at 130 on the 6-month call offset the obligation risk that you take over the next month that requires you to sell the stock at 130. So you can always exercise your long call at any time to satisfy your obligation for the 1-month call that the obligation that you have on it. So that's why spreads, it doesn't eliminate the risk of assignment, but it offsets the risk of assignment. I hope that answered your question, Julie. Leonard is saying, for the short call, are you looking to go to expiration date or settle earlier? Great question, Leonard. And I think that was one of the things that I was trying to cover here, is that on your short call, you always want to roll 1 to 2 weeks prior to expiration. You do not want to hold it to expiration. There's no reason to hold anything to expiration. Could you do a reverse cover call, as in you're long a high strike leap calendar and also continue to sell a lower strike weekly. So you can, but the margin requirement on that will not be the same. The margin requirement on your lower strike call that you're selling is going to be a naked call, because you won't be able to exercise your leap in order to satisfy your obligation on the short call. So you can do it, but it's not very capital efficient, and I don't know why you would want to do it, to be perfectly honest. Isn't a diagonal also a poor man's cover call? It absolutely is. I think the difference between a poor man's cover call and a diagonal is that we generally refer to a poor man's cover call as someone who owns a leap and sells calls against it. Usually diagonals and calendars, the long dated option is not a leap, because a leap is technically a call option that expires 9 months or more. So it's just more of a term, but in actuality, the two are identical. In a diagonal spread, Lance is asking, what happens to the short leg if it goes in the money? Lance, it's the same problem that you have as what happens if you if you have a cover call and the short put goes in and the short call goes in the money. The answer is not much happens. You either have the stock called, you either will end up short the stock, or you have to buy back the short call. So this is why we always say roll your cover call or your short call 1 to 2 weeks from expiration. That's to avoid any type of assignment risk. Roll your calls early. What delta do you recommend if trading a long call diagonal that is out of the money? Example, the long call is 40 delta. What delta would you recommend for the short leg? The same delta for short legs. When you're selling a short leg here, you should really take the same approach that you take with selling covered calls. What call would you sell for the covered call? That's the same call that you should sell on the short call of a diagonal. What's your view on a double diagonal trade? So Han, I'm not going to get into double diagonals. Double diagonals is kind of like, it's kind of like trading a version of an iron condor. My views are the same as this. If you want to trade an iron condor and you don't mind making it a little bit more complicated and understand what risks you add when you trade a double diagonal and what benefits you get from that double diagonal, don't let me stop you from doing it. But make sure that you understand the fundamentals. And that's why I spend so much time teaching the fundamentals. I try to teach you the variations off of those fundamentals so that you can learn to be sufficient on your own. And thank you so much, everyone, for those of you that have shared with me kind of what you've learned. Barry saying, what do you suggest if the stock is assigned early, although this doesn't happen often? So Barry, so I will say that when you get assigned early, I tend to, on a diagonal or calendar, if I get assigned early, just to close out the whole thing. Because it doesn't make sense for me to exercise my long call or put against it, because I lose all the extrinsic value of the long call or put just to satisfy my obligation. Or if you want to continue to own the long call or put, is just simply buy back or sell the stock that you ended up owning as a result of the early exercise. Early exercise is actually a good thing for your diagonal or calendar, because when someone early exercises, they give up the extrinsic value of the call or put. You in turn gain that immediately. You gain that extrinsic value that you would have otherwise have had to hold all the way to expiration in order to gain. Now you're effectively gaining it immediately before expiration. So close out the stock leg that you are assigned on if you want to keep the long call or put. And if you just no longer want to be in the position, close out the whole trade altogether. Michael is saying, you bought 500 shares of X for $56. The stock declines to $50. You wrote 5 cover calls. The stock shoots up to $60. Instead of rolling your cover call, how can I use a diagonal call to possibly have a better outcome from the 500 shares? Michael, so I'm not sure how that turns it into a diagonal. You could trade a diagonal almost as a stock repair strategy also. Because that's really kind of what you're doing is you can sell a call against the stock, and then you can trade a diagonal on top of that as a stock repair strategy. I'm not sure that I understand your question as to how can I use the diagonal call to possibly have a better outcome from the 500 shares. I mean, your cover calls is effectively what you're doing to improve the outcome of your shares. I'm not sure how a diagonal factors into that because what you're referring to is just a standard cover call. Rory is asking, do you sell the short calls if the stock is in a downtrend, or do you wait for the stock to go up before selling the calls to get the more premium? Or Rory asks a great question. Rory's basically saying, if let's say I trade this calendar, and instead of the stock staying neutral, the stock takes a big plunge. Now, when the stock takes a big plunge, let's say the stock goes down to, I don't know, 100. Your first of all, both call options will be close to worthless. Your 6-month 130 call will have a little bit more value. Maybe it's worth $2-3. The 1-month call option will effectively be worthless. So in that particular case, if the stock makes a big plunge well before expiration, then yes, Rory, just like a cover call, what you might want to do is buy back the short call, maybe sell another short call against it. But at that point, you might want to reassess. Do you still want to own your 6-month 130 call option when the stock's trading at 100? Chances are you may not want to own that call option anymore. In that case, you close out both legs. But if you do still want to own that 6-month call option, then you can, yes, collect your premium early by buying it back and selling another call against it. But the challenge here is that you're not going to collect as much premium again to sell another 130 call, and you can't sell a lower call either. You can't sell a 120 call because you own the 130 calls. You cannot sell a call calendar where the short strike is lower than the long strike, because then the obligation risk that you have on the short leg is not actually going to be offset by the option that you have to exercise on the long leg. Logan is saying, thanks for the presentation. It is very good. With the membership of OptionsPlay, will I get the credit spread trade ideas and the corresponding closure of the trade later? Logan, yes, we send you both the entry and exit trades every single day as a member. Ken is saying, I've sold the long-dated 1-year put, 25 strike on Lake, receiving a decent premium. What should I be concerned about? Ken, so that's outside of the scope of this webinar, but when you sell a put, there's only one thing you're concerned about, which is the stock declining. First of all, I would not sell a 1-year put for the same reasons that I just showed you here. The reason that we buy 1-year options is because there's no time decay. If you're going to sell a put option, you're receiving very little time decay. A lot of people look at puts, or when they're selling calls or puts, they look at the wrong thing. They look at how much premium they're collecting as a whole. But what you should be looking at, instead of how much premium you're collecting, is you should be looking at how much premium are you collecting per day. Now, if you sold a 3-month put option on Lake, yes, you would receive less premium. But during those 3 months that you hold it, you're going to collect a lot more in premium than the 1-month call option over the next 9 months. You take on the same risk, but you're collecting a lot less premium. That's why if you're going to sell if you're going to sell options, always sell short-dated options. Never, ever sell options that are greater than roughly 60 days. If you're going longer than 60 days, you're collecting less premium every single day. When you're trading options, when you're selling options, it doesn't matter how much premium you collect. What matters is how much premium you collect per day. Scott is saying, Tony, thanks for the time. What is your view on cutting losses on calendar positions? Still cut losses at 50% premium, similar to debit spreads? Great question, Scott. The answer is yes, because a calendar spread is really a variation of a debit spread. That's really what it is. You're just playing around with the expiration dates a little bit. But yes, if a calendar spread that you own loses more than 50% of its value, in my opinion, that is usually a good time to get out of the trade. I'm talking about in the money long. Tony, I think your question about in the money long. Most trainings I have recommended higher in the money calls for diagonals. Yeah, so Tony, then you're right. So diagonals trading that 60 to 70 delta for the long leg, as I think Ed said before, absolutely fine adjustment to make. I prefer to trade to 50 deltas because of the higher gamma. I want that convexity. But if you want to be a little bit more conservative, you want lower convexity, but you're willing to take on a little bit more risk for that, by all means, make the adjustment to that 60 to 70 delta. Leonard saying, for calendar, when stock trades up, do you look to roll the short call or put against it? Yes, Leonard, just like a cover call, right? When you sell a cover call and the stock rallies higher, you want to roll that call. Same thing here for a calendar or a diagonal spread. Jinru is saying Apple has earnings coming up on 127. Is it a good idea to use diagonal spreads on it? So that depends on what your views are for earnings. If your views are bullish on earnings, mildly bullish on earnings, I would say it's a great strategy to use because it again allows you to take advantage of the volatility crush on the short leg and not take on the delta risk that you have with being short a call or put going into earnings. So like I said, it's kind of like giving you a similar risk profile to short straddles without all of the unlimited risk factor that you have with short straddles. So if you would trade a short straddle or strangle on Apple going into earnings, then calendars and diagonals are a suitable alternative that have limited risk. Jock is saying, are calendar and diagonal a lot of maintenance since we are rolling every 2 weeks? So calendars and diagonals are more maintenance than I would say most other strategies because you have two expiration dates that you have to basically worry about, two completely different legs that you have to worry about. It's really like adding a little bit more complexity to a cover call. So yes, they do require quite a bit of maintenance. What time frame do you start to roll? So I usually roll again about 1 to 2 weeks from expiration is where I would start rolling my calendars and diagonals. Michael's saying, can you give an example of a 50 delta call? Yeah. So look, if you look at the options chain, when you pull up an options chain, there are 3 numbers on the options chain. You have your strike price, you have your premium, and then you have your delta. So if you can see here, the 129s have a delta of 0.5 because that's the strike price closest to the current price of the stock, 128.91. So when you use your drop-down menu, you have your strike price, you have your premium, and then you have your delta on your strike price. Mark is asking, when should you buy calls versus call spreads? Do you have any rule of thumb? Mark, I will tell you that I almost never buy calls. But the rule of thumb here is that you should only buy calls when you expect the stock to make a big move that is greater than what the market expects the stock is capable of moving. Now, I know that's a mouthful, but that's why we say it's bullish. A long call is bullish by a certain amount. Now, that certain amount is dictated by the premium of the call option. And you can think of the premium of the call option as what the market expects the stock to do. So the market is basically saying that the stock is likely going to reach about 143. It might go a little higher, might be a little lower, but on average, based on the volatility of this stock, the stock could move up to about 143 by expiration. So the only reason that you would ever buy a call option is you believe that the market has underpriced the probability of the stock making a big move to the upside. And mathematics shows that in the long run, markets actually not only not price it correctly, it actually overprices the probability of a stock move. So if you look at this trade, more often than not, sometimes the stock makes a big move, sometimes it makes a small move, but on average, the stock will make a smaller move than what the call option prices in. So that's why it almost never makes a lot of sense to just buy the call option. And that's why we almost always spread our trades, whether we trade a debit spread, a credit spread, a calendar, a diagonal, all of these are designed to offset the cost of that long call because markets generally what's the correct term? Markets generally overstate volatility and actually ask for a larger amount than what the market actually historically will move. Michael, thank you so much, Tony. I look forward to your next training webinar. Love these more complicated seminars. Thank you so much, Michael, for your feedback. If you love these more advanced topics, please let us know. We're doing more, the last Friday of this month, we're doing straddles and strangles, more advanced strategy to talk a little bit about, why someone would trade those types of strategies. Scott is saying, on diagonal trades, what's your view on adjusting in the event the stock runs through your short strike prior to 1 to 2 weeks from expiration? So Scott, I mean, you would want to roll your cover calls. So from my view on that is that you can wait, right? So Scott's question is basically, if I sell this diagonal spread and the stock goes from 150 to, let's say, 160 by expiration, I'm sorry, well before the 1 to 2 weeks from expiration, what do you do? The answer is, Scott, in my opinion, is you wait, because the stock can always during that time pull back a little. That way, that will give you the opportunity to make make a profit closer to this peak. But even if the stock continues to go higher or stays the same, you're still going to collect premium here. So that's why if the stock makes a big move in the short run, I would hold it, because you always have the opportunity for the stock to come back. And even if the stock goes higher, your losses here as it goes higher actually diminishes. The further it goes, the less it actually can lose for every dollar it moves higher here. So the more you have to gain here to the downside than you do that you have to lose to the upside. That's why if the stock makes that big move, give it the opportunity to potentially pull back after that big move, instead of rolling early. If the short call expires far from the strike price and is going to be valued at 0, I don't understand why it has to be rolled 1 to 2 weeks from expiration. Angelo, because then you have 1 to 2 weeks where you are gaining nothing. If you roll early, then you can then earn some premium for the other 1 to 2 weeks. If your short strike is already at 0, then there's nothing more that you can gain from that 1 to 2 weeks. That's why you want to roll early. When you roll short call, you roll one leg only. Yes, you're only rolling the short call. But like I said, if let's say the long leg that you bought, let's say you've already, so let's say you buy a 180 call and then you sell a 30-day call against it. But let's say you do this 3 or 4 times, the 30-day call option, and now this is down to 60 days. The $180 call, the 180-day call option is now only 60 days from expiration. Then at that time, you might want to roll both legs. So if you still have that bullish view on the stock, you might roll the 60-day option back to another 180 call option. So that is the only case where you may roll both legs. Why would a call diagonal have 2 break-even prices? So only if, again, only if the debit that you pay is greater than the width will you have 2 break-even prices. If the debit that you pay is less than the width is the distance between the 2 strike prices. If the debit that you pay is less than the width, then you will only have 1 break-even price. Good question. Let's see. Whoops. Where did I lost the questions here? Okay. Max is saying, I'm using a strategy right now to just buy to open calls, then sell to close those calls for a profit. Can you make a quick comment on that strategy? Max, that's just a long call. There's nothing wrong with that call option. There's nothing wrong with that strategy. That's the first one that we covered. There's only some challenges with buying calls, is the fact that you're paying a lot of premium for it. If you can offset some of that premium, more power to you. That's why we trade debit spreads. That's why we trade calendars and diagonals, is to reduce risk and reduce the amount of premium that we're paying. Juan is saying, for your example, 130, 140 call, Apple diagonal has a 126.11 break even, but the 130, 135 Apple diagonal has a break even at 123.25 and 159.55. Juan, exactly. So the 130, 135, you're paying more than the difference between the 2 strike prices, right? So let's go back to February. And you're talking about the 130, 135s. So the 130, 135s, as you can see, cost $8.30. $8.30 for a $5 wide credit spread is uh, is a higher debit than the distance between those two strikes. Because you're paying more, that's why you have two break-even prices. If you have a let's say in this particular case, a $10 wide spread, but only a $9.64 spread, then you only have one break-even price. Michael saying, I thought somehow by using a diagonal call, you can go out further than a cover call. Yes, rolling the call up and out prevents you from having the stock called away from a loss. Michael, you can use a further, you can go out further than a cover call, but I don't know why you would want to. I mean, you don't want to go too far out because then you're collecting less premium per day. The whole point of a vertical spread, of a diagonal spread or calendar spread, is to maximize the differential between what you're buying and what you're selling. If you can maximize that as much as possible, if you sell, let's say you end up buying this and selling this, the differential between the two isn't very large and you're really not getting the benefit, versus if you're selling something out here, the differential between these two are greater, and that's going to help offset the premium that you pay. Harley is saying, if I buy a 1 year at the money leap today and decide to sell calls against the leap sometime later, must one use the leap strike price in order to have an offset to early settle? So Bob, as long as the call that you're selling is higher than the strike price of the call that you're buying, you could do that. You just cannot sell the strike price of a call lower than the strike price of the call that you purchased. Sir Nath, your question about getting the emails. Send me an email up here. Saying that on the platform, since you're a member on the platform, click on this thing up here. Questions, ask us. Send me that, and I'll reply to it as soon as we finish here today. If you have a calendar spread with expirations 30 days apart, you can't really roll the short leg without rolling the long leg, correct? Yes. So as you get close, if your calendar spread is that tight, then yes, you're going to have to roll both legs. Phil is saying, do you do personal trading? Phil, if you mean, do I trade my own personal account? The answer is absolutely yes. Nabil is saying, how accurate is the expected price on Think or Swim? So Nabil, I don't know what you mean by expected price, if you don't mind clarifying. Paul Chan, Paul, I hope that this is the Paul that I know in Canada. If it is, I hope you're doing well. He's saying, would I love to see more scenarios? I would love to see more scenarios play out, such as broken wing butterfly and when they're ideal to be used, or how to leg out of a credit spread when the stock moved against you. I know this is still time sensitive for these webinars. Would it be possible to reach out to OptionsPlay for a consultation on what to do? Paul, you can send us an email to this questions ask us. I'm happy to try to answer as many questions as possible, but I will say that I cannot provide personal investment advice. I can only provide you with what are considered best practices for each scenario. Do you factor in volatility rank for calendar and diagonal trades? So Wayne, the problem with IV rank, right? And this is one of my biggest gripes with IV rank, is that IV rank is generally measured from 30-day volatility. It doesn't give you a good sense of what the 6-month volatility is, what the 1-month volatility is. It is very good at helping you understand what the rough, volatility of the money of the options that are expiring, somewhere between 30 to 45 days. What it doesn't tell you is the differential between the 6-month option and the 1-month option that you're buying versus selling. So IV rank is not good at all for showing you that. You really have to pull up the full options chain. You have to look at the volatility of the 30-day option, and then look at the volatility of the 180-day option. Look at the differential between the two. That's going to give you the numbers that you're looking for trading diagonals and calendars. When rolling option, how do I roll on the same strike? Eric, I'm not sure what do you mean by how do you roll on the same strike? If you don't mind, let me know. Oh, Nabil is saying the expected move. So the expected move, historically has been has been back tested to always slightly overstate the reality. So expected move is pretty accurate, but it's always slightly greater than what reality ends up being. Phil, if your question is on one-on-one training, no, we don't. But Phil, that's why we do these sessions. We try to, we do members only sessions, so they're a little bit more lower in terms of number, so we can get to your questions. But we don't do one-on-one training, but we do a lot of these trainings every single week so that you can see the different topics. We record them all so that you can watch them. We do long Q&A sessions, so we answer all of your questions before we jump off here. Richard's saying, can you please explain how to get to 2 BE points on calendars? Richard, it's not something that you can get. It's just all comes down to how much you have to pay. So this is a $10 wide calendar spread. I'm paying less than $10 here, $9.64. That I only have one break-even price. And then if I'm trading a calendar spread, in this particular case, that's $5 wide, but I'm paying more than $5 like I'm doing here, $8.30. That's when I'm going to have 2 break-even prices. It's not something you create. It's just a matter of how much the premium of the trade cost or not. Richard saying, what are the biggest differences, if any, between a call diagonal calendar and a put diagonal calendar? So Richard, the biggest difference is really whether you're bullish or bearish on it. You wouldn't trade a call calendar or diagonal. If you're bearish, you would only trade a put calendar or diagonal if you were bearish. So it's really just directional view. Okay, with that covers all of the questions that I see so far. Any other questions here? Is there a correlation between theta and volatility or any of the other Greeks? Is there any correlation between theta and vol? I would say all of them are in some way correlated to vol. The higher the volatility, the bigger the theta, but also the bigger the gamma. So yes, they're all correlated. At what level do you have to be in order to trade calendar? I think I've answered that question already. In calendar spreads, are you not exposed to being assigned either due to price move or other things like dividends? So Jay, whenever you're short any option, you always have that risk. You're always exposed. But with spreads, you offset that risk by being long the option. So when you're short the option, you have the obligation. But when you're long the option, you have the right. So as long as you have the right to offset the obligation, that's why brokerage firms do not require, the full margin requirement to sell a naked call or put when you trade a spread. So you always have the long leg to offset the risk or the exposure that you have on the short leg. A lot of investors seem to be concerned about assignment. And I just want to reiterate again, when you're trading these types of spreads, don't be so afraid of assignments. Assignments, I know, is not a fun exercise, but it's not an exercise that changes your risk. If you get assigned early, your risk stays the same. Your risk does not change as you get assigned early. You simply have to close out the stock leg if you don't have the capital to maintain it, but it doesn't change the risk of your trade. It doesn't add risk to your trade is the point that I'm trying to make. What are the downsides of using calendar spreads or diagonals for leaps? What are the downsides of using calendar spreads or diagonals for leaps? I would say the downside is if the stock, so for example, you own a leap because you think the stock's going to make a move to the upside, right? So you own this June 135 because you think the stock's going to go higher, and instead you trade a diagonal. The downside is, what if the stock makes a big move to the upside? Let's say by June, the stock is at 180, or let's not even talk about June. Let's say by February 19th, when the first option expires, if the stock makes a big move, so you got the direction correct, but you traded a calendar or a diagonal here, you have a loss on the trade. But if you just outright bought the call option, you're looking at a 227% return. So that's your downside that you take when you're trading a diagonal. Okay, with that, that covers the questions that I was able to get through here today. I really hope that this was helpful in giving you a better understanding of calendars and diagonals. And like I said, this is just scratching the surface in terms of showing you how creative you can get with your option strategies. So with that, thank you so much. We'll send out the recordings as soon as we finish here today, and send you also the link to the slides along with it. And I really look forward to those of you that submitted your symbols for tomorrow morning on the members only session, and going through a lot of the symbols that you guys have submitted. So looking forward to that tomorrow morning, 8:30 a.m. Looking forward to seeing you there. Have a great evening, and I'll see you guys in the morning.